Welcome to This Week in Impact, where we bring you some of the most interesting impact investing and sustainable finance stories of the week, as covered by Impact Alpha. I'm Brian Walsh. It's Thursday, October 3rd. I'm joined today by Impact Alpha's editor, David Bank. We'll discuss new insurance models that aim to climate-proof homes and towns, enhanced efforts to support diverse, emerging fund managers, and how private equity is funding fossil fuel investments. That's all coming up on This Week in Impact. Hi, David. How are you?
Hey, I'm doing great, Brian. How are you?
Doing well, thanks. Well, first up, it's been over a week since Hurricane Helene made landfall with devastating impacts. More than 175 people have been killed by the storm across 6 states in the U.S., and damage estimates are as high as $160 billion. Much of that damage took many by surprise, occurring far from shore, in mountain towns and inland fields, places where few people have flood insurance. David, the Impact Alpha team looked into new models for insurance to help both homeowners and local communities meet the challenges of increasingly intense and increasingly frequent climate disasters. Can you tell them a little bit about them?
Well, Brian, the devastation, and as people are seeing, and it's coming clear more and more, is just incredible. We were just in Asheville over the summer in July and walking along the banks of that North Fork of the Swananoa River, and that whole farm area. There's a college there called Warren Wilson College we were visiting. Has just been wiped out. Our friend Kevin Jones, many people know him from the SOCAP conferences and neighborhood economics, says the river was running through his and Rosalie's home for 6 hours, and he's right down there also in that same area. So the scale of the devastation, I think, is just becoming clear to outsiders. And what we're keying on in this story is that, you think that you've got insurance, but it turns out that, mostly the things that happen to you are not insured. And so there's been a lot of talk of sort of the climate pressure on insurers. And one way in which they're dealing with it, of course, is to get out of insuring things that are becoming riskier and riskier because of climate. I will say just that flood insurance was mostly excluded from homeowner policies way earlier, than the current sort of concern about climate change. And so most of these homes in North Carolina that had no flood insurance, not because they were withdrawn because of high flood risk, but just because they had never gotten it either through their insurers or through this national flood insurance program. But all over the country, homeowners and policies are being canceled for hurricane risk. Out here in California for wildfire risk. We've long excluded earthquake insurance. I in our house, I do have earthquake insurance, even though it's kind of universally understood to be a sort of lousy deal. But I just feel after paying in for so many years that I have a sort of superstition that the minute I drop my premiums, that's when the big one will come.
No, but this home insurance issue is really huge because if these insurance companies keep on leaving these communities and these states, that makes the home prices essentially unaffordable because many mortgage providers, of course, require you to have home insurance. But if there isn't home insurance, then you can't get the mortgage, you can't buy the home. And so it's kind of exacerbating the already tenuous issue with the housing supply in the U.S.
Absolutely. And just like you say, it has all these ripple effects, which are just starting to be felt as people can't buy homes, people can't sell homes, then, value of homes falls, plus just the risk of, not being insured, if you do lose everything, and how do you rebuild and whatnot. So this is one of the many manifestations of what people are calling climate inflation. So, price of housing going up, as you said, and, price of groceries going up, as we've reported, because of floods and droughts in growing areas, and also, risks to cities for, eroding the tax base and unable to then pay for the very infrastructure that they need to be able to be resilient to the climate risks. So these are some of the things that folks are working on, though. I mean, again, every crisis presents some opportunities.
Yeah, and there was a full-day insurance-focused conference last week at Climate Week in New York that was hosted by a Boston-based nonprofit called Insure that is focused on catalyzing climate-smart insurance innovation. So what does climate-smart insurance innovation look like?
Yeah, we had our colleague Ryan Jones out there in Climate Week at that session you mentioned, and essentially there were two kind of potential solutions. One's called community-based catastrophe insurance. And essentially, the city or the locality, a government agency, essentially represents like a kind of collective bargaining agent for the residents and the businesses, and so negotiates essentially a region-wide or a community-wide rate, and that sort of changes the power dynamics, I guess, in the rate setting. So it can also like let places become insurable that were not getting insurance. Again, all insurance is essentially pooled risk, and so if you can bring a bigger pool into the market, then you can insure more people with sort of social coverage. The other one sort of builds on that as well, but at one level up, which is cities themselves forming a pool so that you have a much more diversified set of risks. And again, you might have a mountain area and a low-lying area and a coastal area and an inland area, and so over time you presumably diversify. And so that's been called a municipal risk pool. So again, the cities and the insurance companies and the consumer advocates are trying to figure out ways to kind of keep the rickety boat afloat, as it were, in this climate, in this newly risky climate environment.
And it's risky in not just the kind of classic or traditional areas where people expect. They expect wildfires in California, they expect hurricanes in Florida, but you have some areas. You mentioned Asheville, North Carolina, which was even recently called a climate haven, and people just did not expect this kind of impact. So I think the lesson here is that no place is safe, and that we need to be mindful of how do we protect from future disasters by ensuring that we have the proper coverage that meets the increasing demand that we're going to see.
There you go. But I think, to be honest, we called that part of the Appalachians a climate haven for good reasons a few months ago. But just as you say, like there was just a rate hike on coastal North Carolina, because that's usually on the Atlantic coast, more in the face of the hurricanes. And then this one came up from around the back and up through the panhandle of Florida, and then up into the Appalachians from that side. So you never quite know. And again, these things are becoming more frequent, bigger damages, and of course the human and social kind of toll is just heartbreaking and huge.
It is indeed devastating. All right, well, let's take a quick break. When we come back, we'll discuss some of the barriers to getting more money into the hands of diverse, often first-time fund managers. David, this week we published our monthly list, that's with 2 I's, a selection of impact-oriented funds that have recently been on the market raising capital. These are curated monthly based on public or accessible information. This month's list takes a look at diverse, first-time fund managers, a reflection of the astounding fact that the share of capital managed worldwide by women and indigenous and non-white individuals has remained stuck at 2% or less for many years now. David, there have been deliberate efforts to expand the share of capital that is owned and managed by non-white, non-wealthy, non-men, but it's barely moved the dial. Why is that so?
Well, there was, you say it's an astounding fact, the 2%. What's really the astounding fact is that it's stuck there for so long. And it did blip up a little bit, in the pandemic days and around some of the pledges made after the murder of George Floyd. And then it's, ticked back down. So it's kind of stubbornly stuck in that, crazy range now. And so the question becomes, how do you both get new managers ready and stood up? I mean, fund management is itself a business, and at small fund sizes, it's not actually that good of a business, because you've got, generally speaking, like 2% fees of the assets you've got. And if you've got a small fund and you've got to pay, your associates and your all your research and your operating costs and whatnot, you're living on quite thin margins. One of the things that does is excludes folks who can't kind of stake themselves to the beginning. So there have been a number of efforts. It seemed to be an increasing number of efforts to kind of get the emerging fund managers the resources they need to just stay in business long enough to get the track record that will let them raise the larger funds, and then the fund economics become somewhat better. So the it's very prosaic things. It's working capital. It's bridge financing, and then this interesting phenomena of deal warehousing, where you're trying to get a track record, but you haven't closed the fund yet. So how do you show that you know how to put deals together and work with entrepreneurs and spot opportunities? And so sometimes the backers now will actually stake that first deal and let you finance that company, and essentially put it in what they call a warehouse. And when you've raised the fund, you can bring it back. It becomes part of the portfolio. So lots of efforts like this. We covered one for Mission Driven Finance, which is raising this $10 million fund, and I think has gotten about halfway there for just that sort of thing. But there's a number of other efforts, and one of the things that comes through in all these stories is that emerging managers, it's not just the first fund. It's not even only sometimes the second fund. Sometimes you're considered emerging all the way to the third fund before at least the bigger institutional players will take a look at you. So if we want to get more folks in, more diverse flow of capital, flowing frankly to a more diverse set of founders and entrepreneurs and kinds of ventures and communities, the field has sort of taken notice that they've got to provide that kind of support.
And it's not just the money; it's the time it takes to raise the money.
Well, time is money. So if it takes you 2 years to raise the fund, you're not even getting the fees for those 2 years. You got to support yourself and presumably pay some expenses. So and the fundraising cycle, as you know, has been very long in recent years. So it's quite a barrier to entry, and in particular for non-affluent people. If you've just exited your tech unicorn and you're setting yourself up as a venture capitalist because you're so smart that you should manage other people's money as well, you've got sort of a gentleman VC or a gentle lady VC kind of business going. But if you're trying to put money into diverse entrepreneurs in communities that are undercapitalized already, and you're trying to make a go of that as a viable impact alpha business proposition, it's tough sledding. And so again, bridging people over that gap so they can prove themselves, so they can raise the money, is what folks are trying to lean into.
And so is this a clear market failure? So what are the kind of market solutions to address this market failure?
Well, it is kind of a market failure, partly in the sense that there's some data through the surveys and whatnot that first-time fund managers actually outperform. So the counter argument is always that the risks are higher and you don't know, and how do you underwrite it? And if you're a big institutional investor, you need to write a bigger check, and that it represents too great a share of that fund, and that overwhelms some limits you've set. So there's all kinds of kind of institutional reasons not to invest in first-time fund managers. And particularly also emerging managers in diverse managers looking in different areas, different industries, different target markets, but actually you're leaving some returns on the table by not doing it. And so again, staking these people so they can get going. Funds of funds have become a one method. That you diversify the risk by investing in a basket of diverse and emerging fund managers. As I said, these kind of working capital advances, deal warehousing, and then frankly, the Impact Alpha publishes, as you mentioned, the list each month of funds that are actively raising. Many of them turn out, of course, to be emerging and diverse managers who found their way to us, or we found our way to them. And we have more set of pretty good set of anecdotal stories of folks getting calls from limited partners looking to invest in new kinds of fund managers, and sometimes even closing those investments. So getting the word out is something we can do, and helping bridge these interim finances is something the whole field can do.
Right, it becomes almost a Kafka-esque or catch-22, where you can't raise capital without a track record, and you can't get a track record unless you raise capital.
Indeed, and it's at some level that was intentional to try to sort of weed out fly by night operators or something, but it also weeds out folks who just don't come from the same, sort of pattern of schooling or tech corridors or other places where VCs and private equity partners have been minted, previously. And if we want to get money out to different kinds of companies, different kinds of ventures, different kinds of ideas, different communities, we have to also, empower different kinds of fund managers to make those investments.
Right, and this isn't money out in the philanthropic sense. It's money out actually for the impact alpha sense, right? It's getting money into the hands of diverse fund managers who will be looking at diverse opportunities that are usually overlooked by those fund managers that look like all the other fund managers.
Absolutely, it's like deepening the pipeline and pool of ventures and companies, and places where those companies are located and people that they're reaching. And you need to do that, starting from the capital allocation at one end, and obviously the entrepreneurs and the founders and the innovators at the other. But it's got to come together in a much more diverse and broad based marketplace.
All right, well, let's take another quick break. When we come back, we'll discuss a new report that notes that the private equity industry has invested $1 trillion in fossil fuel energy companies since 2010. It's not just global banks that are doubling down on carbon-emitting fuels. A new report by the nonprofit consortium Private Equity Climate Risks finds that the top 21 private equity firms, including Blackstone and KKR, which collectively manage $6 trillion, have invested roughly $1 trillion in fossil fuel energy companies since 2010. David, what are we to make of these findings?
Brian, yeah, it's kind of interesting coming off the last story, the emerging managers having trouble raising money. These are the biggest private equity firms in the world, and they don't really actually have much trouble raising money. Maybe things ebb and flow a little bit, but one thing they've raised a lot of money on in recent years is kind of multi-billion-dollar climate funds. And so a number of these and impact funds, a number of these private equity firms really tout their kind of climate and renewable portfolios and sort of have protest that they've got climate religion. And then here comes this report that shows that they're still heavily invested in the fossil fuel economy. From a pure profit seeking perspective, that's not surprising. Oil prices have been high. There's new technology, in fracking and everything else that folks are investing in. But some of this is very old school stuff. Part of this report, I was surprised to learn Blackstone had invested in a coal mine in the so-called Gavin coal plant in Ohio, that was once called, America's deadliest coal plant for its sulfuric acid plumes, and so. That's not really the image that Blackstone's putting forward, when it talks about its renewable, and infrastructure, green infrastructure type investments.
Yeah, an interesting aspect to this is the private in private equity. A lot of these investments happen outside of the public eye. They don't get as much scrutiny as the big banks and some of the other investment funds that also finance energy companies, especially carbon-intensive energy companies. So, what are we to make of the kind of the very nature of this industry being more quiet and off the beaten path?
Well, it is called private equity, but actually some of the private equity firms are themselves public companies and do report, to shareholders, and are tapping the public markets in their own businesses. But yeah, as you say, the banks and the corporations, get dinged by shareholders, sometimes by protesters in the streets, in the case of BlackRock or what have you, and private equity has generally flown under the radar. Sometimes a little bit less clear who owns what. They all have kind of adopted a sort of euphemism we've been noticing of, instead of talking about renewables or sustainable or clean or green, they now talk about the energy transition or even the climate transition, and that kind of provides a cover for staying in fossil fuels under the argument that we're going to need all kinds of fuel to satisfy demand in the next few years, and that the natural gas, for example, might be considered a transitional fuel away from coal, but before you get to renewables. So some of it has some grain of truth, but it is sort of a euphemism for being able to stay in fossils. And as you said, particularly when now after years of kind of flat electricity demand, it's spiking in the U.S. and the reason is data centers and particularly AI, and the private equity industry, as a whole, is playing a very large role in financing the tech giants and other players who are putting in these giant data centers. So as you said, there is a business opportunity, to be in energy, and frankly, that's what these guys do. So I think the incumbent on folks to both point out the risks. There's lots of stranded assets to be coming down the pike in fossil fuels, and also that just where they want their which kind of future they want to place their bets on as LPs. So that's universities, foundations, pension funds, just voting with their dollars.
Yeah, I'm reminded of a quote from one of the leaders of one of the investment banks during the financial crisis in 2008. In the run-up to that, knowing that he was getting involved in some risky investments, that he said, well, as long as the music is playing, we have to dance. And so maybe we're seeing a same trend here. As long as there's money to be made in fossil fuels, the private equity industry will be there to collect those fees.
Strong dose of reality there, Brian. Thank you.
All right. Well, that's going to do it for This Week in Impact. Thank you, David.
Thanks, Brian.
And thank you all for listening. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. Smart conversations by and for impact investing professionals. For more exclusive stories about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing to Impact Alpha. Just go to impactalpha.com/subscribe for full access. If you like the show, please subscribe to the podcast wherever you listen and be sure to leave us a 5-star rating. It really helps other people discover the show. Thanks, as always, to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh. We'll see you next week for more Impact.